Hello guys, welcome back to my channel. Continuing with the journal, that is in relation to the dissolution, we have few further points which we will discuss today. Let's see what journal entries would be made at the dissolution of the firm of partners A and B. Old furniture which was written off from the book now realized at 20,000. So what is coming into the business? That is money. Here, what is coming in the business? That is money. What is going out? Old furniture which was written off earlier, not recorded, whatsoever is the case. The point is, when you are making a dissolution entry, if there is any of the asset, whether recorded, not recorded, written off, that is to be transferred to realization account only. So here what is coming in bank, what is going out furniture, we can't write furniture asset which is not recorded, we will write it with the word realization only. So first transaction being old furniture sold, that was for rupees 20,000 and we are done with here first transaction. The second point is that an old customer whose account was written off. Again he is saying an old customer whose account was written off with 20,000. I am not concerned with what it was there, what it was written off. Now what is the point at the time of the dissolution? What is happening? That it is realized with the value of 7,000. How much money firm got? 7,000. From where it got? That is an old customer who was the debtor of the firm. So an asset, because debtor is an asset, it would be transferred to which account? Realization account. So the journal would remain same. Bank account debit to realization account, that is with the value of rupees 7,000. We are not concerned with what was its book value or with what it has been recorded, not recorded. What is realized, that is important here only. Now the next is A agreed. Who is A? A is a partner of the firm. A agreed to take over the goodwill of the firm which was not recorded in the books at rupees 50,000. A is taking an asset at rupees 50,000. So if the asset is sold, which account is debited? Bank. Now, if the asset is not sold, it is taken over by a partner. Who is the receiver? Partner. So, partner's capital account is debited. Here, they were debited for debit what comes into the firm, and here it was debited for debit the receiver. So, who is the receiver? That is A. When asset is going out, it is sold out, it is recorded, not recorded. Which account is to be credited? Realization account. Reciprocal account could be bank or the partner's capital account. If it is taken over by the partner, it would be debited to the partner account. Being asset taken over or goodwill taken over, whether recorded or not recorded, I am telling you that does not matter. If something is giving the money to the firm, it would be transferred to which account? Realization account. Now, investment costing 20,000, that is 200 shares. So that means 200 shares. If the investment is 20,000 and 200 were the number of the shares, what was the value of each share? That is rupees 100. So it was purchased for 100 rupees. Now valued at 15. I have already told you that at what value these were existing, not existing, does not matter. What is their realizable value? That is matter to us. So how many number of shares? There were 200 number of shares which are right now valued at rupees 15 each. So what is the value at which they realized is 3,000. If they would have been sold, we would have written bank account debit to realization, but they were taken over by the partners in their profit sharing ratio. So here, not only A's account would be debited, rather both the partner took over the share. So who are the receivers? They are A and B, both are the receivers of whom? Of the share. So which account is credited? Realization account. What is the value of the share on the dissolution date? That was 3,000. So in the profit sharing ratio, no profit sharing ratio is given to us. So they will be distributed equally, being shares taken over by the partners, right? So this is the narration which we put over here. This is also done, point number 4. Now coming to the point number 5. Realization expenses paid by the firm. So when the realization expenses are paid, what is going out? That is money. For what purpose that money is going out? To meet out the dissolution expenses, realization expenses, when the firm is dissolving the assets and making the payment of the liabilities, there would be some incidental expenses which are named as realization expenses. Now they are met by the firm themselves. So for liabilities payment, what account is debited? Realization account. So to bank. Asset realized, bank to realization, liability paid off, realization to bank. Being realization expenses met by firm is the narration in this point. So this is also done with the point number 5. Now point number 6. Realization expenses were of the firm but were met by B. Now liability paid should be debited to which account? I have told you, realization account. But money is not going out. If the money is not going out, who is ready to pay the expense of the firm? That is B. So B is actually giving the firm's expenses. Who is the giver? That is B. So B should be credited with rupees 2,000 here. So being expenses, being realization expenses met by B. So that is the narration and the point is done over here. If the expenses are met by the firm, realization to bank. If met by the partner, then realization account debit to partner's capital account. So this is for the day, the journal for the dissolution. We will be coming up with more points. Thanks for the day. Countitude, like, share and subscribe. Keep scoring.